Good. So Tuan asked me to speak about the impact of the pandemic on the global economy and to say a little bit about supply chain changes. So this is really more about the broad economic context than just China. So if you can see the slide that we're looking at, it shows the IMF's most recent forecast, which just came out a few days ago. It's more pessimistic than previous forecasts. You can see that they're suggesting that the world economy is going to drop by about 4.9% this year. And you can see that it's quite negative for the United States and even more negative for the European Union, especially for Italy, Spain, and France. But you can also see, if you look on down, that Japan is having a tough problem, that India, which really worries me quite a bit, is having sharp negative growth in deep negative territory. I'm not sure people realize the damage that this is doing to the world economy, and that the length of time it's going to take to recover from it, which is a point I want to make in just a second. Let me go to the next slide. If I can make the slides work here. Let me just page down. So this is the US economy right here. And you can see that in the first quarter, it's gone sharply negative by 5.2%. And when the second quarter numbers come out the day after tomorrow, it's probably going to be worse. This is our unemployment rate, which most of you have heard of. It's gone up to about 15%. It's dropped back down to about 13%. This is not going to go away anytime soon. It will be several years before our unemployment rate comes back down again. We've spent a lot of money trying to slow down the economic catastrophe. More than $3 trillion has now been spent. But I want to just show you that this is going to cause our fiscal deficit to be negative this year by about 3.5 times what it was negative last year. And it was already deeply negative last year because of the Trump tax cuts. So this is a forecast for the United States of our fiscal deficit, of our debt, and because of that, the consequences for several of our important trust funds, especially Social Security and Medicare. So it's very likely that our debt to GDP will jump from about 79% to about 118% this year. Now, with very low interest rates, we can probably afford that. But if interest rates go up by as much as 1%, our debt service is going to be overwhelming. So the IMF also put out the fiscal balances and gross debt for a bunch of the countries whose economies it forecasts. And I just want to show you this. You can see that the United States gross debt, not the debt held by the public, but the gross debt actually goes up to about 140%. You can see Italy's debt is at 160%. And as you all know, Italy is not growing. So again, if interest rates go back up to 1.5%, Italy and perhaps Spain and Greece and Portugal will not be able to afford their debt service. You can see the debt is also very significant for India. You can see it's very significant for Brazil. So this financial crisis is going to be a problem, not just this year and next year, but in 2022, 23, and 24. Let me say a word about global value chains. This is a map of the value chains showing who innovates, who manufactures, where raw materials come from. And you can see the Australian contribution to raw materials. You can see that China is the largest intermediate manufacturer. I want to show you China's real GDP very quickly. You can see that it's gone sharply negative. The previous forecast I just showed you shows them recovering at 1% by the end of the year. That remains to be seen. This is what's happened to Chinese trade, and you can see it's gone down, not sharply, but it's gone down. I do want to say one thing on China's behalf. China's gotten a lot of grief for slowing exports of the medical equipment that the rest of the world needed. And this chart shows that they actually slowed their medical exports less than their overall exports. So I don't think they were really trying to hurt the rest of the world in pandemic situation. This shows U.S. trade, and you can see it's sharply dropped. So if you think about the U.S.-Chinese trade relationship, it's really withering, and it's withering more on the U.S. side than the Chinese side. So this is a recent, very recent, last week study of supply chains. And this is something that began several years ago, but has really accelerated because of the pandemic. A lot of companies are trying to rebalance their supply chains, shifting some of their business out of China, perhaps to Vietnam, perhaps to Bangladesh, certainly to India, and also to Mexico, which is interesting. And it's especially U.S. firms that are doing this. You'll notice that European firms have not moved very much of their supply chain. So let me just offer a couple of thoughts on what's happening to these global supply chains. First of all, the disruptions are not new. We've seen them before with the Japanese tsunami and the global financial crisis. But in those cases, they were either supply shocks or demand shocks. The pandemic is presenting both supply and demand shocks. So this is really exceptional. And it hits all the major economic centers simultaneously, which the previous shocks did not. So the companies involved are trading off just-in-time production, hyper-specialization, minimizing inventories for more political sustainability. And of course, the US-China trade wars have significantly exacerbated this. Both we're seeing reshoring to the United States and diversification again to Vietnam and Bangladesh and Mexico. And this is all part of what I consider to be a deglobalization trend that began 2 or 3 years ago. So I'm gonna end here very quickly by saying a couple of words of general conclusions. These are not the only ones. These are the ones that, from an economics point of view, I think are most important. So let me just point to these, because I think it's important to think about the US-China relationship in the context of the global economy. So the first point is that everyone is running larger deficits and therefore incurred more debt. So that's an important point. As I just showed with the United States, our deficit was 1.1 trillion. And now this year it's going to be 3.7 trillion. And that assumes that we don't pass more economic stimulus in August, which Congress is currently discussing. So the debt is going to rise sharply. And it's going to do that in Europe. It's going to do that in Japan. It's going to do that in the United States, in India, in Brazil, in Australia, everywhere. Debt service, therefore, is going to rise as soon as we have any inflation and an increase in interest rates. That's a big deal. If debt service only goes up by, if interest rates only go up by 1 or 1.5%, debt service as part of a fiscal budget could rise tremendously. Many states will not be able to afford that, particularly the southern tier of Europe, some of the Latin American countries, Argentina, obviously, Venezuela, perhaps Colombia, perhaps Brazil, and many African countries won't be able to afford it and are already having their debt deferred by the IMF. So I think we've got an economic situation that is going to hang over all of us for several years. The second point I would just make here is that I think government intervention in the economy is normalizing. For those of us who support a capitalist environment, I think we're going to see government becoming a much larger player in the economy. If you think about the United States, it's obvious that healthcare is going to be more important, but also minimum wages, income inequality. These are issues that the Republican Party has not been willing to deal with. Those are going to be becoming part of our economic policy. Let me go to the third point, which is deglobalization. And again, I think this is accelerated. It is accelerated for two reasons, partly because of the pandemic and its effects on trade and the movement of people, but partly because of the policies of the Donald Trump administration, which I think have been a catastrophe for the United States. Number 4 is U.S.-China relations. And you all have talked about that for several hours now. We've really pushed these in a negative direction for the last 3.5 years. They've really have reached a low ebb with the Hong Kong decision yesterday. I think we have to think about this. China and the United States simply have to get along. We cannot have a war. So we have to think about what both countries need as a minimum, and where and how we're going to continue to function together in the future. Finally, I would just point to the fifth consequence, which is that I think European economic integration is under severe pressure because of the economic effects of the virus. Northern Europe is in pretty good shape. Southern Europe is a catastrophe. We saw this with the financial crisis in 2008 and 2009. Northern Europe had to bail out Southern Europe. This is a much larger economic crisis, and I think Northern Europe is less inclined to bail out Southern Europe, which needs it much more. So one could think about many other microeconomic impacts, but these are the macro impacts that I see that this virus has created. So I'll leave it there and let someone else talk. Thank you.